Why does the stock market sometimes feel less like a logical system and more like, well, a giant, chaotic casino? Today, we're jumping into Burton Malkiel's masterpiece, A Random Walk Down Wall Street, to really get to the bottom of the wild psychology that fuels market booms, busts, and what's often called the madness of crowds. So let's start with the absolute core question, the billion-dollar question that has really kept investors up at night for centuries. What is something, a stock, a bond, a house, what is it actually worth? And it turns out the answer to that is a huge battleground between two completely different ways of thinking. On one side, you've got the firm foundation theory. This idea says that every investment has a real, solid, calculable value based on things like its assets and how much money it's making. But on the other side, you have the castle in the air theory. This one argues that an asset is only worth what somebody else is willing to pay you for it. So it's this constant battle, right? Logic versus emotion. And that's what makes the market so fascinating and, honestly, so unpredictable. Now, the firm foundation theory, this is for the detectives of the investing world. Think of someone like Warren Buffett, digging through financial statements, hunting for clues to a company's true value, its intrinsic value. The whole game here is to find that solid, unshakable foundation and then simply buy the stock for less than it's really worth.
The castle in the air theory, though, is a totally different ballgame. It's way less about spreadsheets and much more about playing a psychological game with the market. See, the goal isn't to figure out what a stock is actually worth, but to guess what someone else, often called the greater fool, is going to think it's worth tomorrow. You're not really buying a business, you're just building this beautiful castle up in the sky, hoping you can sell it to an admiring crowd before it all disappears.
So what happens when an entire market gets swept up in building these castles in the air? Well, the results can be absolutely spectacular and utterly devastating. Let's take a little walk through some of history's most famous financial bubbles. Our first stop is 17th century Holland and the infamous tulip mania. So a rare virus was creating these incredible fiery patterns on tulip petals, which turned these flowers into the ultimate status symbol. Pretty soon, people weren't buying bulbs to plant, they were speculating. They were trading their homes, their entire life savings, all for a single fragile flower. Fast forward about a century to England, and the South Sea bubble takes hold. The public's hunger for new investments was just so intense that promoters could get away with almost anything. And check this out. This is a real prospectus. An entrepreneur literally raised money for a secret project, and people just lined up to hand over their cash. He took the money, of course, and was gone the very next day. And the ideas just got wilder from there. This here is the Puckle machine, a real proposal for a gun designed to shoot square bullets. Because, why not? It is the perfect example of the kind of completely nonsensical castles in the air people were willing to pour their money into, all in the desperate hope of finding the next big thing. And this chart, this is what happens when those castles finally come crashing down. This is the actual stock chart of the South Sea Company. You can see that breathtaking rise, a tenfold increase in a single year, and then a collapse that was just as fast and just as brutal. Now here's the kicker. Nobody is immune to this stuff. Sir Isaac Newton, one of the greatest scientific minds in all of human history, was an investor. He got in early, made a nice profit, and sold. But then he watched his friends get even richer, got swept up in the FOMO, and jumped back in right near the top. He lost an absolute fortune, which led him to say this. All right, now let's jump across the Atlantic and forward in time to what is probably the most infamous financial disaster of the 20th century, the Great Crash of 1929. The Roaring '20s were this time of just incredible optimism, and Wall Street was the place to be. But a lot of that excitement was actually a carefully crafted illusion. You had these groups of wealthy traders forming pools to manipulate stock prices, creating phony trades among themselves. These were called wash sales, all to create the illusion of huge demand and suck in unsuspecting investors. And the optimism was absolutely infectious. It reached all the way to the highest levels of academia. Just days before the crash, one of America's most respected economists, Irving Fisher, made this now infamous declaration. It just perfectly captures the spirit of an era that honestly believed the party would never end. And then, the party was over. The crash wasn't just some minor correction, it was a total cataclysm. I mean, just look at these blue-chip giants of the time. General Electric, Montgomery Ward, RCA. These were the absolute bedrock of American industry, and they lost over 90% of their value, completely wiping out an entire generation of investors. You would think that after a trauma like the Great Depression, investors would have learned their lesson about the madness of crowds, right? But as we're about to see, the siren song of easy money is just really, really hard to resist. So you're probably thinking, okay, that was a different time. Surely today's professional, super sophisticated investors are immune to this kind of mania. Well, the 1960s and 70s would prove that the answer to that question is a resounding nope. Back in the 1960s, the magic word was electronics. Investors, and I'm talking professional funds too, just went absolutely nuts for anything with tronics in its name. There was this company that sold records door to door called American Music Guild. They changed their name to Space Tone, and their stock price shot up 600%. And then you had the conglomerate boom, which was basically a masterclass in financial sleight of hand. Here's how the trick worked. A glamour company with a high stock price, a high PE ratio, would go and buy a boring company with a low PE ratio. When they merged, the market would magically start valuing the combined company at the glamour stock's high multiple. And just like that, poof, earnings per share would jump, creating this total illusion of growth out of thin air. And for a little while, the market was completely captivated by this financial magic. They bid up the prices of these conglomerates to these just dizzying heights. But that kind of magic couldn't last forever. Once the acquisition slowed down, the artificial growth just vanished. And as you can see from these numbers, those sky-high valuations came crashing right back down to earth. But maybe the most telling bubble of that whole era didn't involve shady accounting or trendy new tech. No, this one involved the most respected, most trusted, blue-chip companies in all of America. They were called the Nifty 50. These were the giants, IBM, Disney, McDonald's, and the professional consensus at the time was that they were one-decision stocks. The idea was, you just buy them and you hold them forever. The growth was so certain, they said, that you couldn't possibly pay too high a price. But here's the thing, you can pay too high a price. When the market finally turned, these beloved stocks got absolutely crushed. Some of them fell 80 or even 90%. And that's the key lesson here. Even the greatest company in the world can be a terrible investment if you wildly overpay for it. The Nifty 50 proved that even the bluest of blue chips can become a castle in the air. So, from tulip bulbs in the 17th century to the tech darlings of the 20th, the specific castles in the air might change, but the underlying human psychology, that powerful tug-of-war between greed and fear, that remains a constant driving force in financial markets. It just keeps happening. And this leaves us with a really fascinating paradox. If markets are so often driven by this madness of crowds, by these psychological waves of boom and bust, how can any investor ever hope to find solid ground? The answer, as Malkiel suggests, might not be in trying to outsmart the crowd, but in understanding it, and maybe, most importantly, in understanding ourselves.